And when they finally, the error is exposed, it's like ripping a bandage, taking a needle out of your arm that's been giving you hallucinogenic drugs for the last 15 years. And suddenly reality hits, regardless of what the Fed does. Like in 2000, 2002, they cut rates like crazy. 2007 to 2009 onward, they cut rates like crazy. It didn't help the stock market. And so when the bubble breaks, and when I look at the S&P and NASDAQ, we're looking at quarterly momentum breakage that's a handful of percent below where you are right now. But there's some initial breakage that occurs 1% or 2% below where you are right now. And once you break quarterly momentum, which is where we measure price in relation to its 3-quarter moving average, it's almost like a 200-day. There's a structure there that when you break it says, oh, this is like 87 or 29. They both have the same structure on quarterly. But the problem now is when you run annual momentum of the S&P or the NASDAQ 100, especially the NASDAQ 100. No, I would take that back. S&P and NASDAQ equally. If you get quarterly momentum breakage and it commences in this quarter, that'll drive price down. You can't drive it down because when you open next year, the numbers it takes to blow the floor out of annual momentum will be in your face. So a 10 or 15% drop now will be different than any one we've seen in the last several years because this one's going to blow annual momentum structure, which is the big dog. You break it and you're down for a couple of years. And I think that's the domino effect that's about to